In this week's update, the Fed removes any remaining doubt about rates. The market reaction is emphatic and it's very telling. And the next step in successful portfolio construction and management. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Over the last couple of weeks, I've been working through a process of successful investing. The 4 key steps, just to recap: get a clear and simple plan for you, understand where the high probability growth targets are. Thirdly, develop an entry and management plan that works for you, and that's what we're going to address this morning. And finally, stay the journey. Don't jump at shadows. Don't be put off by short-term events or a shift in consensus thinking that's just not reacting to the wrong things. So they're the 4 key elements that I believe are involved in successful investing. So let's look at the third one, which is the entry and management plan that is suitable for you. And everyone, to a degree, is different in this respect. So there is no, one cookie cutter kind of solution. It's a matter of tailoring it for yourself. And the reality is that just about everybody needs some sort of help with that. Now, there can be different plans for different stocks. In fact, that's probably going to be the norm for most people. You don't have to have one plan that applies to everything. But the important thing is just to be clear about what that different plan is for different stocks. Importantly, to document it. And then, unless circumstances change dramatically, then stick to it. Don't be put off by short-term events. So some of the aspects to consider. What is your purpose? Is this a long-term investment, or is this a shorter or medium-term trade, which is perhaps more technically driven, the first one being a bit more fundamentally driven? So, what is your purpose? For other people, the purpose might be for dividends and long-term dividend growth. And nothing wrong with that as long as you don't get caught in a dividend trap. Are you going to buy these investments in a single purchase, or is it going to be a multi-purchase strategy? Again, all these things can be decided in advance, and in fact must be decided in advance. There's no point in changing the purpose along the way. What is the total weighting that you are targeting for that particular stock? And if you are buying in a multi-entry technique, then what are the partial weightings as well? Again, everything is decided in advance. What do the entry triggers look like? There's several entry triggers that lead to highly probable outcomes. What are the ones that you're using? What are you looking for? What are the profit-taking triggers, or the triggers to, in fact, get out because the investment hasn't worked out? What are they? What do they look like? All very important things. And let me show you some examples just to illustrate. And these aren't recommendations at all. These are just examples of what I'm talking about. Firstly, let's look at a stock, 88 or Ordinate Group. It's a quality long-term growth investment when you look at it from a fundamental point of view, and has been for quite some time. It has a near monopoly on the audio-visual industry and should be a good long-term investment. However, as with all investments, they get too expensive at times, and it's just had a very, very substantial move to the upside of about 60%. So this is probably not one that you'd want to be buying now. The entry triggers. If you're looking for a significant retracement, which is always good technique, and I've indicated a couple of points here where there were a significant retracement, or there was significant retracement here, and again here. Do you require reversal confirmation? So are you looking for the price action to actually show you that you've reached a base and you've turned up? Or are you just perhaps working off technical support and not really needing the reversal confirmation? Or alternatively, some people might be looking at buying into a breakout. There is a technique called buying new 52-week highs, which has some validity. I'm a bit skeptical about it in certain market conditions, but it certainly has some validity. So these are all the decisions that could be made in advance. Now, when it comes to profit taking, in my view, in long-term investments, trailing stops are useless, because if it's a long-term investment, your trailing stop has to be fairly wide. Otherwise, you're going to get knocked out prematurely by just any old random price movement. And if you are running a wide stop loss in a long-term investment, then often, in my experience, when you've had a significant retracement, it's not the time to be selling; it's the time to be buying. So trailing stops are useless in my view. There are far better techniques that we've been employing that get you out much earlier. So again, just clarity around purpose. Is your purpose to participate in the long-term growth of the company and not react to short-term events? So that is the purpose, and it's quite clear. But then you can get the situation where what if the company is truly a world-class, highest quality company, but the growth in earnings and therefore the growth in the share price is just not enough to meet your performance hurdles. So let me show you a stock that everyone is familiar with, and that's CSL. CSL, great company, but the long-term returns they're okay, but they don't shoot the lights out, and so they may not meet the performance hurdles that you have. And in the Insiders Club, that is the case. However, that doesn't mean there isn't an opportunity. Now, if we look at the meaningful corrections in CSL, correction number one here was a retracement of 25%. And following that, the stock, after that retracement, the stock went on to make a 150% plus advance in the next 21 months. Move on to the second point. We got a 26% retracement at point 2, which was 2018 down to September to November 2018, 26% retracement, followed by a 98% advance in 16 months. Now, we're at point 3 at the moment. We had a 27% retracement, and now we've had a very nice reversal, and it's all looking, it's all looking pretty good. So rather than being in a stock like CSL for the very long term and getting perhaps a mediocre return, there are ways to participate in stocks of this quality and get a much better return. But again, it just gets down to being organised and being clear about your purpose and clear about your plan. Third one I want to have a look at. Let's say you've identified a quality long-term achiever. This is a stock called Goodman Group that ticks all the fundamental boxes, which this stock has done for quite some time. But it's expensive. And a lot of the time, it's expensive. So it goes on the watch list from my perspective. We're waiting for a changed environment. That might take 6 months, a year, 2 years. But eventually, a much better opportunity will come along. So if you've got a truly high-quality, outstanding asset, then there will be a point where you'll get a great opportunity, just as we saw with CSL on the previous chart. So if we look at, there's a couple of entry points here. We had a very significant advance, and then we got quite a significant retracement from nearly $27 down to about $17. There was a reversal, and that reversal took the price up quite significantly. So a partial position with a predetermined maximum, 0.1, would have yielded a short-term return. And then the second opportunity occurred when the price completed the correction down to a major support, put in another major reversal signal, and allowed a second position to be taken. Now, there are many other examples that I could go through to illustrate the point, but the overall is clarity about purpose and clarity about process being organised, being patient, and not losing sight of the opportunities. So that's the key the key message that I want to get across. Now, just a perspective on this level of organisation, because I would expect that a number of people are going to look at what I just covered and think, well, it seems like a heck of a lot of work. How the hell am I going to keep that up year after year? But my perspective on that is it's your choice. You can either wing it and just, play it as it comes, or you can prepare for long-term investing success. And they're very, very different. If you're going to wing it, I don't know. I just think your financial future is far too important to be winging long-term investment, not having a structured plan and just hoping that it all works out. Well, the other alternative, of course, is to prepare for success, and that's what these 4 weeks of perspective on investing is all about. And it's not that much effort, really. And if you don't believe that you can sustain the focus to do this, then get someone else to help you organise it. That's pretty much why specialist share education exists, is to help people get organised and execute reliably over the long term. And whenever anyone's honest enough to say that they balk at paying someone to help them with this, I just shake my head in disbelief at the false economy of it. It really is crazy. And just consider this, and this is, this is not making any claims to any performance, but just some mathematics to make the point. If you start with $100,000 and you're getting a 10% return per annum, then after 10 years, you're going to be at $259,000. But if you're getting a 20% return, then that's going to be $619,000. The point is that just a minor improvement in your long-term return makes an enormous amount of difference to your long-term wealth. So if you want to set yourself up properly, then this is the process, what I'm going through. And the vast majority of investors just need help with it. That's just the reality. They don't have the time, they don't have the interest, and they don't have the focus to execute it over the long term. So they need the structure, they need the selections, and I guess the ongoing perspective to stay disciplined, not to get put off by events. So I hope this is resonating with at least some of you, because it's just such an important and clear structure for getting good long-term returns. Now, I'll complete this little series on December 31. There'll be no video next week on Christmas Eve for pretty obvious reasons, but on December 31, we'll just look at the final element, and that is about staying the journey and not jumping at shadows. All right, American stocks for the week. Had a great week, finished well. Thursday and Friday rose 2.5%, and it's up 15% now in 7 weeks from the October low. Of course, we've got all the usual suspects. We've got the big Magnificent Seven, as they're now called, leading the way, but the breadth is enormous, all the way down to the small caps, as we'll see in a minute. So this has been a very, very impressive rally. The US dollar index was off a little bit again, 102.59, now that the Fed has made it pretty clear that it's highly unlikely we're going to get any more rate rises. It would need a reversal in the current trends we're seeing in inflation and the economy. So they've made that pretty clear. And they've also put on the table that it's likely that we'll see 3 rate cuts in 2024. And this was just music to the market's ears. And as a result, the US dollar sold down a bit, and the yield is down to 3.91. The VIX still steady at 12 and a bit, so that's pretty low. And the 10-year, 2-year spread, though, in the bond market is still negative 0.52. So the bond market hasn't sort of given up yet on on a worsening economic situation. Let's go and look at some charts. So we'll start with, in fact, let's start with the S&P. So this is the S&P on a daily. This was the bottom on October 27, and I've been talking about this every Sunday since. It's pretty much just gone up almost in a straight line. Yes, it's overbought now, but there's a lot of dynamics that are still working in favour of pushing the the index up higher. So that's on a daily chart. Let's just look at it on a weekly. So we're getting up close towards these all-time highs, which were in January of 2022. So we're not very far off that. The all-time high was just on 4,800. We closed at 4,720. So only another 80 points to those all-time highs. So this has been a pretty meteoric rise. Let's look at within the market. This is semiconductors versus the S&P. And again, I've been calling this every step of the way since we saw the bottom. I think it was around about here, the start of 2023, the end of 2022, when I started talking about the fact that the market was changing. You only had to look at semiconductors, look at XLK. There was plenty of evidence. Now, that doesn't mean that 2023 was easy, because it wasn't. It was very hard. And it was very hard because a lot of the market was actually in a bear market, and particularly small caps, and particularly small cap mining stocks. So 2023 was very tough, but the reversal in the index was pretty obvious if you knew what to look for. Or let me put that another way. The reversal in the smart money flows was pretty obvious if you knew what to look for. And that's what all these charts are about. It's not just looking at the index, it's showing you where the smart money is going. So that's semiconductors versus the S&P, and it just looks very, very strong. This is the NASDAQ versus the S&P, same story. Very, very, very similar chart. So the market has been backing, the point is, the market has been backing the more aggressive sectors of the market in preference to the more defensive sectors. And it's been doing it all year, but it's been doing it at the big end of town. But we're now seeing that start to filter down. Let's look at the relative comparisons over the last quarter in the US. XLK at the top still, and clearly that's been the case for some time. So that's all the big tech stocks. Then finance, consumer services, communication services, beg your pardon, which is an aggressive sector. And then we've got healthcare and materials and so on. Consumer discretionary and materials. And then we've got healthcare. So that's the last quarter. If we have a look at the last 2 weeks, just to see if there's any change, consumer discretionary has absolutely rocketed in the last 2 weeks. So the market in the States is betting that the consumer is going to remain highly resilient, and the consumer is 70% of the US economy. So that's a big vote of confidence for the US economy. Technology has done well in the last couple of weeks. Finance, materials, not a lot of difference to these in the last couple of weeks. And you'll note what's important is that we've got consumer staples underperforming in the last couple of weeks. And also, if we look at it, it hasn't exactly been the top performer during a year that I think many people would have expected defensive consumer staple stocks to have been near the top of the tree. So I'm here. Let's look at Australia. This is the last quarter. We've got materials. Healthcare has staged an enormous recovery from lagging earlier in the year. And then we've got finance. Small caps have also picked up with the increase in small caps in the last quarter, and then we've got information technology has also done quite a lot of catching up. Again, let's just go in and look at the last couple of weeks. So healthcare has had a massive rebound. Then information technology. So these were great opportunities. You wind back a month or 2 months, and there were screaming opportunities in healthcare, in some of the world's best stocks, and also in information technology as well. Materials has done well, etc. So that's what the individual money flows look like. Now, if we go to something like IWM, so this is the Russell 2000, we've had a very, very nice reversal and increase. It was trading down 162 on the Russell back in October, and we finished the week at almost 200. So that's a very significant move. It's in excess of 20%. Interestingly, though, if you put this on the weekly chart, you can see that we've had a very big sideways move here for some time. So you've got to go back to January of 2022. So that's almost 2 years of consolidation in the Russell 2000. So the smaller end of the market. But look at the move just in the last several weeks, and particularly the week just gone. Now, yes, it pulled back a little bit from the highs, but that's not unusual. But to me, this is the strongest move, and it's accompanied by some really good volume. You look at this move here. Yeah, the candles look good, but look at the volumes. Again, this move up here looked okay for 3 or 4 weeks, but lacking volume. Got a little bit better here initially, but not sustained. The volumes went away. But look at this period. Look at the volumes have been sustained, and they're still growing. So I fully expect to see the Russell break out and start to get back and challenge its previous highs. And that's very, very positive for the market. Turning now to Aussie stocks, the Aussie dollar, 66.38. Our market gained 3.8% across the week. And we're finally seeing small caps really building momentum and being rewarded for just being great growth companies. And also we're seeing some green shoots in lithium. Whether it's a short squeeze, although that's not the case generally with the early stage developers, but whether it's a short squeeze or whether it's just a rethink on where the lithium market is going, it's hard to tell at this stage. But certainly some improvement in lithium, and I'll have a bit more to say about that shortly. So let's just have a quick look. First of all, just do the currencies. This is the US dollar. We did get a reversal back up on Friday, but it still wasn't enough for the week. We had significant declines on Wednesday and Thursday. If we look at the Australian dollar, pretty much mirrors it, as nearly always does, and helped along by the just quite illogical strength in the iron ore price, which is really quite amazing. So just have a quick look at the ASX 200. So it's been a really good couple of weeks, as you can see, and enormous volumes went through on the ASX 200 to finish off the week. And if we pan back, have a look at the big picture, we're still, the all-time highs up here are just over 7,600. We closed at 7,440. So we're still 150, 160 points away from the all-time highs. So that's the market setup. Let's look at gold. Gold on a daily basis. Now, this is quite amazing. And it just shows you how manipulated the gold price is. So on a single session, and admittedly, part of it was during a point of lower liquidity, lower activity in the gold market. But I think that's just the opportunity that the forces that are manipulating the gold price take advantage of. So on the 4th of December, we had a high of 21.30 and a low of 20.20 on the one day, $110 range. Now, spare me. What does that? What can cause the gold price to fluctuate by $110 in a single 24-hour period without overt manipulation? And that's why I haven't been trusting of the gold price for many years. Now that abrupt breakout and then failure on the one day was then followed predictably by some more selling. So the speculators who jumped on this breakout got their fingers burnt, and there was some follow-through selling. And then we get another abrupt turnaround last Wednesday with the Fed announcements. And so that's where we finished on the week. If you look at on a weekly chart, and whilst this is all unpredictable, have a look at what we've got. Just stand back and look at what we've got. We've got higher lows. So I'm not making a prediction this is going to break out because I really don't trust it. But the fact is, if you're just looking at the chart, we've got a higher low. We've got a higher low. So is it building up? Was this just the precursor and we are going to get a breakout? I really don't know. But it's certainly become very volatile in the gold market. But if we go to GDXJ, which is, I think, the most relevant global index for gold stocks, it's not the reaction from the stock market that I would have expected, either positive or negative. It's just another week of really going nowhere. Okay, so let's just run through that quickly. So gold finished at 2020, but we are forming higher lows. That's the key point. Lower in Australian dollars again. If you remember 2 weeks ago, we were up at, I think, close to 31.50 in Aussie dollars. We've dropped about $100 in Aussie, and just another sort of nothing week really. There was one other thing that I wanted to do. Let's just have a look at the 10-year Treasury yield. Let's look at year to date. So there's the year to date on the Treasury yield. So we've returned almost to where we started. So we started the year at around 3.7. We went just over 5, and now we've come back down to 3.9. So it really has been a year of extraordinary moves. And for the 10-year Treasury yield, that's a lot of very significant moves. Just while I'm here, let's look at the crude oil price. And again, I'll put this on a year-to-date chart. Just you can get a sense of what the whole thing looks like. So we had a couple of dips. We got down to 67.5, and then another dip down to 67, and we have been just under 70 recently. So 70-ish or just under seems to be the floor price for crude oil, and that's certainly where OPEC, I think, wants to see it, somewhere between 70 and 80. So that's sort of the long term, and I'll make a comment about that in a minute when we get there. Copper, 3.83, so it worked its way a bit higher, and nickel still in the doldrums. 71.8 was where we finished, and as I said, $70 is shaping as that floor price. But I think the long-term outlook, given the fact that the usage of oil is not going to go away for decades to come, despite what some people would want to see happen, it's going to be around for decades, and the severe underinvestment in oil exploration is almost certainly going to mean that supply will not be able to keep up with demand. And so therefore, the long-term price for crude oil, I believe, has got to move higher. Lithium, I guess there was more proof during the week of a very erratic speculators market in lithium. This is still a very young, very immature market, and yet stock prices are getting murdered on the basis of a market that is just not providing a true reflection of supply and demand. And I think we will see. We've probably got to wait until February, but when we see the actual prices achieved by companies like Pilbara Mines, Min Resources, IGO, etc., Alchem, when we see what they're actually getting, rather than some spot price that may or may not be remotely representative of what's going on in the market, then we'll have a better fix. So, hopefully another 6, 7, 8 weeks, and we'll have a much better fix on this. The fact is, on the information that I have, that EV sales in China are on the rise, despite some commentary to the contrary. And I always just keep coming back, because if lithium is a long-term story, it's extremely difficult to trade in and out of at the moment because of the volatility. But as a long-term investment avenue, I'm still 100% there. And I just look at the amount of money that's validating that long-term future. Just look at the billions of dollars that Albemarle, SQM, Alchem, Pilbara Mines, Min Resources, Rio Tinto moving into lithium, ExxonMobil moving into lithium brines, and of course Gina Reinhardt with Hancock Mining, and all of the activities that they've partaken in the lithium space this year. It's too much money by very astute, very knowledgeable, and very smart people to not be a valid long-term future. So that's the way that I look at the lithium market, and it's probably already started. We have the perfect setup for a short squeeze because Pilbara Mines was the most shorted stock on the ASX. It was being priced as though it was going to struggle, big time to make a dollar. But in fact, even at significantly lower levels of spodumene than where we're at the moment on spot sales, it's still very profitable. But as I said before, I'm really waiting with bated breath to see what the actual price is that a company like Pilbara Mines achieved in the last 6 months. All right, there's the spot copper chart, bit of a tick up, as you can see. I narrowed it down, just come down to the last 60 days in the LME copper warehouse, that their copper inventories have come down, so that's helped the price a little. There's a spot nickel chart, still did tick up a little last week, but still struggling with, particularly with what's happening with Indonesia and nickel. And nickel stocks continuing to climb, so that's certainly not helping there. Wrapping it all up, final thoughts. What can being highly organised deliver? Is it worth doing, or do you just do the same old? Well, in my view, significantly better long-term returns are on offer. And as that little mathematical calculation I did before, it makes a massive difference over periods of 10, 20, 30 years to your long-term wealth outcome. It is absolutely massive. So it's worth having. And most investors, I've been working with investors for more than 20 years, and most investors are just not organised, or they cannot sustain the focus to execute effectively. It's just the reality. And that's not a criticism, it's just the reality of where the vast majority of people are at. And those investors would benefit enormously from getting help with devising a suitable plan, getting one-on-one support to execute it reliably, all those things that I've talked about through this series. So from my perspective, generating long-term wealth is just too important to leave to luck, and that's what most people are still doing, which is a great show. Portfolio analyst last week, there was a perspective on dividends versus capital gain. I've got some very firm views on that, but I'm sort of willing to be open-minded that there is a place for dividends, but there is an alternative. You can have both. It's not an either or. And we also looked at lithium. So what was the status quo of lithium and where we're at the moment? That's it for this week. There's more information on the website. There's my email address. So no video next Sunday, Christmas Eve, but there will be a video on New Year's Eve. So I'll see you then. Cheers.